Hi everyone, welcome back to my channel Commerce Student. Today we will be discussing about some basic terms used in accounting. This video is the part 1 of the same. Now let's get started. Let's begin with our first term, that is proprietor or owner. This is the person who steps up to kickstart the business, investing their hard-earned money and bravely shouldering all the risks. They are the heartbeat of the business operation. Now let's talk about money, that is capital. It is the sum the owner invests into the business, whether in the form of cash, goods, or assets, like furniture, machinery, etc. Take, for instance, Mr. Ahmed. He launches his business with cash amounting to rupees 50,000 and furniture worth rupees 10,000. Also remember that capital increases with profits and decreases with losses and drawings. Now let's talk about something called drawings. This is basically what the owner takes out from the business for personal use. It could be in the form of cash, goods, or assets. Going back to our previous example, Mr. Ahmed, who started with 50,000 in cash and 10,000 in furniture, decided to withdraw rupees 3,000 for his personal need. This amount of 3,000 is what is called drawings. Business transaction. This is the core of business. It's when a business gives or gets goods or services, either paying cash or promising to pay later. It's like a simple exchange, a constant flow of stuff that shapes the business's money picture. In a nutshell, it is the ongoing trade that keeps the business wheels turning. Let's further understand the concept of business transaction with some illustrations given. We have to identify which of the following qualify as a business transaction. First, Somnath started business with rupees 3 lakh. So is it a business transaction or not? Well, the answer is yes, it is. Why? Because cash is being invested in business, worth rupees 3 lakh. Second, purchased equipment is for cash rupees 15,000. Again, it is a business transaction because asset is purchased for business. Third, appointed Mamta as manager on a monthly salary of rupees 12,000. See, appointment of manager is not a business transaction because there is no exchange or movement of money at present. However, when salary becomes due or is paid, it will be treated as business transaction. So you have to be very careful in this situation. Fourth, profit estimated in future rupees 25,000. This is not a business transaction as profit is not yet earned. It is only estimated. We don't have earned any profit. Debtor. A debtor is someone who owes money to the business. Think of it like when you lend money to someone and they promise to return it. That someone is a debtor. And when we talk about all these individual debtors together, we call them sundry debtors or total debtors. So it's just a group of individuals who collectively owe something to the business. Creditor. A creditor is the person to whom the business owes money, typically arising from goods purchased, services rendered, or other contractual obligations. We collectively call them as sundry creditors, total creditors, or even trade creditors. Now let's further understand the concept of debtor and creditor by an example. Suppose Reddy sells goods to Rahul for rupees 40,000, providing a 2-month credit period for the transaction. For Reddy's business, Rahul becomes a debtor. Why? Because Rahul now holds a financial obligation owing rupees 40,000 for the goods. Now shift the perspective to Rahul's business. In this context, Reddy transforms into a creditor. Why? Because he is the one who extended credit to Rahul trusting him to settle the dues. Receivables. Receivables is the sum that others owe to your business. When goods are sold on credit to customers, they might accept bills which are drawn by the seller or creditor. These bills are accepted as per the Negotiable Instruments Act. For a creditor, these are called bills receivable. The total of debtors and bills receivable equals to accounts receivables. Payables. Payables is the sum which business owes to others when goods are purchased on credit from suppliers. The business may accept bills drawn by the seller. These bills of exchange for a customer becomes bills payable. The total of creditors and bills payable equals to accounts payable. Debit and credit. In accounting, the left-hand side of any account is called the debit side and the right-hand side is the credit side. Now don't let these terms confuse you. In accounting, debit and credit don't have any other meaning beyond this. We abbreviate debit as DR and credit as CR. Goods. Every item purchased for sale in the regular course of business falls under this category. It's not just what you sell, it also includes raw materials bought for further processing. For instance, if a furniture dealer purchases furniture, those are goods for them. If it's a car dealer buying cars, again, that's their version of goods. However, if a cloth merchant or a fan manufacturer buys furniture or cars, these items become assets for them. Why? Because these items are not meant for resale in their usual line of business. That's all for today. If you enjoyed this video, give it a like, comment, share it with others. And please subscribe to my channel, press the bell icon to get notified for future updates. Until next time, keep learning and growing. See you in next video.